Good morning, everyone. Welcome to the Francis Financial Webinar. We are going to talk about the whether we're in a recession or not. What does that look like, and whether it's got anything to do with the most recent recession we saw in 2008, 2009. Your hosts are Avni Ramnani, myself. I'm the Director of Financial Planning and Wealth Management at Francis Financial, and the illustrious Paul Stages, who's our Senior Advisor. Go ahead, Paul.
I was just going to say welcome, everyone. Wish I could say it's a beautiful morning, but fortunately, I think most of us are indoors anyway. But thank you for that intro, Avni. Take it away.
Thank you. So as we go on, we will just be talking about a few things. Paul, if you don't mind going to the next slide. Thank you. We'll do a little bit of a recap of what we talked about last week. The different programs that are coming into place and starting to work. Some recent developments. And then, just talking about whether this could be a 2008-like crisis, or what does that have to do with the crisis that we're facing today, and how can we learn what lessons have we learned from there, and what might the future look like? So we'll do a little bit of a crystal ball gazing as well. And then just going back to talking about, what has the market's done for investors like us, and what can we do as investors to take advantage or survive even this market. We'll talk a little bit about self-care, extremely important in times like this, and then we'll address questions and comments. So Paul, I think this is a good time to just talk a little bit about what happened in the last week's presentation. We talked a lot about the CARES Act that the federal government has put into place, getting cash for your small business, social distancing guidelines that were extended in the US. So again, we're definitely in social distancing mode through April 30th. And then there's discussion about whether it's going to go beyond that or not. The market volatility, which calmed down a little bit because of the actions that the Federal Reserve is put into place, and even the federal government. So a lot of good support for the economy, and we talked a little bit about that. We also talked about an additional stimulus package after the CARES Act was passed by bipartisan support. So there was a lot of good information. If you did not participate in the webinar last week and want that information, reach out to us. We can definitely send you a link to the recording. We also talked about the Paycheck Protection Program, the PPP. The SBA provided relief to America's small businesses. They did it pretty quickly. They have learned their lessons from the past crisis, especially the 2008 crisis, where the lesson learned was there wasn't enough, there was too little, too late. And they try to fix that this time around. Let's see, how much impact that might have. Businesses are being allowed to borrow money to cover qualified costs, such as employee payroll, rent, utilities, things like that, encouraging them to keep that liquidity going. And then some of these loans can also be converted to grants. So basically, you don't have to pay them back if you use it for qualified purposes. So these are essentially just money being given by the government to small businesses to help them survive this, to help them keep them afloat. Again, there's no personal guarantees or collateral required, and you can only apply for one PPP loan per tax ID. So that there are some checks and balances there as well. We also talked a lot about just what business owners should be doing at this point. And our recommendation is to apply immediately. As soon as possible, you should apply. And it takes a while. The systems are being overloaded with applications. So it really, there's a lot of, there might be glitches and things like that. But as soon as you apply, the sooner you apply, the better it is. Because although the applications can be submitted through June 30th, the funds are only going to be given out on a first come, first served basis, and they have a limit to the amount of funds that are available. So that's why we said apply immediately.
And I think, Avni, just based on some anecdotal evidence, we are seeing that this money is going by pretty quickly, because as you can imagine, there are a lot of small business owners in America who are desperate right now and are applying for this. So fortunately, we are seeing, and I'll talk about in a little bit, that there could be some additional money coming down the
Mhm,
pike, but
mhm.
it's definitely very competitive. So you want to get your foot in the door, so to speak.
That's right. That's absolutely right. You know, by the last weekend, only 13 banks had links available. It's increased more. A lot of personal bankers at each of these places are helping clients out. They are doing everything that they can, but it's quite a load on the system, as you can imagine. For independent contractors and self-employed people too, the date for starting to apply was April 10th. So hopefully, if there are any independent contractors and self-employed people, they've also started applying as well. So I can get
Mhm.
out there, get there quickly. And they're doing a lot of assistance for families too, right, Paul?
Yes, yes. And so this is more directly for individuals who have been impacted, their employment has been impacted, either their own or a spouse's, where we're seeing that unemployment insurance, so unemployment benefits, are being increased by $600 a week for 4 months. And these benefits are also being expanded in coverage. So typically, self-employed individuals, independent contractors, so 1099 employees, um, they haven't been covered before under unemployment insurance, but they are covered now, because this is desperate times call for desperate measures, and it was great to see that this is a benefit that's being extended to almost anyone um, who can qualify for it. So to successfully file for unemployment insurance, then I'll put a disclaimer here that this applies at least for New York. So if you are outside of New York, you'll want to go on your own state's Department of Labor website and check out what the requirements are. But this is for, I believe most of our viewers tuning in today are in New York, where filing for unemployment insurance benefits is based on your last name. So if your last name starts with A through F, you'll file today, for instance. G through N, you'll file on Tuesday. O through Z, file on Wednesday. And if you missed any of those days, then you can file Thursday, Friday, or Saturday. And you will want to talk to a real person over the phone. So website is just a good starting point. Then you'll want to pick up the phone and talk to someone. And I can imagine there'll probably be a very long wait, but be patient and know that there is money that's set aside that's dedicated for you if you meet the qualifications, which you'll see on this chart is, when in doubt, we would say just check out the website and give the program a call, because you can see the only people who wouldn't qualify here are individuals that can basically continue to work with pay. So that seems pretty self-explanatory. I'll run through some examples here of some others where you can qualify. For instance, if you have insufficient work history, but you've been affected by COVID-19. If you're seeking just part-time employment, but you're affected by COVID-19. If you became the major breadwinner because your spouse, your partner, who is the head of household, died from COVID-19, you can qualify as well. So there's many scenarios where you can qualify for unemployment insurance at this time. And then this is a flow chart. I won't go through all of it because, again, if you think that you might qualify, here's the New York website here. It's labor.ny.gov. The phone number here is 1-888-209-8124. We'll also have this presentation available by the end of today, if not tomorrow, so you can visit this slide in particular. This is slide 11 of 33. Essentially what this is saying is, if you have any doubts about whether or not you are eligible, if you haven't been eligible before, just try it out, see what happens, and it could be that you'll receive your typical unemployment insurance plus $600 per week until July 31st. And then, as we alluded to before, federal government has stepped up and put in provisions. The Federal Reserve this past Monday announced that they're starting a new program that's going to help finance loans for banks and lenders, because we're seeing that there's such a strong demand out there from small and mid-sized businesses for the loans that Avni was talking about before. So this will help these lenders have more liquidity, more cash to be able to extend these loans to businesses out there who need them, that are guaranteed by the Payroll Protection Program. And the goal is to alleviate the shortage in lenders that's currently going on, because, again, there's just such strong demand out there. And in the original kind of iteration of the CARES Act, there was $350 billion that was allocated for small businesses. It's looking like Congress is going to approve an additional $250 billion, again, to help kind of bridge this gap, as the economy is still relatively at a standstill, to help small business owners meet their immediate expenses. So hopefully this is something that should pass relatively soon. So we're going to be monitoring this, and we'll provide an update, I imagine, next week. And so, Avni, this is kind of the headliner for today of, are we in an 08 style crisis? What does that look like? What are some comparisons, some contrasts that can be drawn?
Yes, Paul. And as you can imagine, economists are having a field day with this one. There's a lot of research being done right now, trying to understand, what are the impacts that this crisis are going to have in the future, and what the economy might look like in a few weeks, a few months, and a few years. So they are going back to studying what the 2008 economy, what the 2008 crisis looked like, and what did the economies do back then. So what economists love to play games with words, and what they're calling this is shock geometry. Essentially what it is if you plot the curves, there are a couple of curves, and I'll tell you what they're made up of, but if you plot these curves, what shape does the line take, the line of growth take historically, and what are those shapes telling us? So there were three major shapes that the economists are looking at: the V shape, the U shape, and the L shape. And I read somewhere where if you scramble these around, they actually spell LUB. So it's they're having some fun with this too. So the V-shaped curve was what Canada experienced during the 2008 crisis. And if you look at the y-axis, it's the GDP in Canadian trillion dollars that in 2012, the level of GDP. And then if you look below on the x-axis, the horizontal axis, that's the years, the historical years. So 1998, 2000, 2005, 2010, and so on. So they plotted, the black line that they plotted was what the projections were pre-crisis, what the projection of the growth trend for the Canadian economy. How would the GDP grow? And these were projections from before the crisis actually hit. And then they measured and plotted in the pink line, the inchworm, where they plotted the actual growth of the economy. And as you can see that up until about 2010, the actual growth was just very much in line with the projected growth. And 2008, just before 2010, just 2008, 2009, there was a dip in that growth. The dip wasn't very large, but there was definitely a dip. And then through 2010 and 2011, it climbed back up and then went back to the original growth projection, to that black line. They call it the V-shaped curve. So the economy takes a dip, but goes back to the original growth projections.
So essentially, Avni, what you're saying is it's sharp to begin with.
Mm-hmm.
So that's got to be scary, I imagine, for especially folks in Canada during this time, and then a sharp recovery.
That's right.
And so that's the V.
That's
Okay.
the V, exactly. Now we look at the U-shaped curve, which is what the United States experienced. So again, on the vertical axis, you see the real GDP of United States, and then the same number of years on the horizontal axis. And when the growth rate was plotted, that's the black line. This is the pre-crisis growth rate. And then they started plotting the pink line, which is what the actual growth rate looked like. So as you can see, the growth rate is keeping pretty much in track with the black line, with the predictions. And then when 2008 hit, there was this sharp decline. There was a decline in the GDP growth. And it stayed, it kind of flattened for a little bit and then came back up, but the strength wasn't as much as what Canada had seen. And then yes, so the growth rate came back, which means the percentage of growth that the economy saw was pretty good, but it never went back to the original growth expectations from before the crisis. So it took a dip, stayed for a little bit, came back up, but was never able to climb back to the predictions. And what that showed was that there was lost capacity, there was some lost opportunities in the market and in the economy, and the economy was never able to come back. So that was the U-shaped curve. And again, this was, as we've seen in the past 9, 10, 11 years, that it wasn't bad. It wasn't too bad. So that's something we should remember. Now let's look at the L-shaped curve, which Greece unfortunately saw. So Greece, the GDP of Greece was, when they tracked the growth from the previous economy from the previous predictions, pre-crisis predictions, that was the black line. And this is the growth that they actually experienced, the pink line. So as you can see, in 2008, they experienced that sharp turn. And then there was a little bit of a uptick, but it wasn't sustainable. It flattened out and then fell. So what this shows is that they couldn't recover as much, back to their original track as Canada did. They couldn't even recover and keep up the same rate of growth. The economy just fell and then petered out and sort of tried to come back up, but is nowhere near close to what the pre-crisis growth projections look like. So the big question is, why did Canada do what they, why did the Canadian experience was so different than the US experience and the Greek experience? We hopefully don't want to have that same type of experience here. So when we looked at the 2008 crisis, some of the biggest problems that came into focus was the problems around liquidity and the problems of capital. So liquidity is basically, having the money circulate in the market, having that flow of just cash flow in the market so that credit can be given easily, investments can be made by companies, by individuals. Here, mostly companies, because those make a huge impact in the economy. So those liquidity problems really were are what causes supply side issues. So economies have, when there is a liquidity problem, it directly impacts the economies in the long run. Similarly, with capital problems, if capital doesn't flow, if companies are not able to take their capital, be assured and say, okay, if I make these investments in putting up new manufacturing plants or retail outlets or building new malls and things like that, if I'm not able to invest that capital into these different projects, then ultimately growth will suffer. So these were two big problems that we saw occur in the 2008 crisis. Now, when we go on, Paul, if you could go to the
Mm-hmm.
next slide, thank you. So what came into focus with the economy in Canada? So their big problem was, if you look at the scale on the left, the color-coded scale, uh, the blue is the least impact on growth, and the dark, like almost brown, is the most impact on growth. So what the Canadian system experienced was that that coral color, I don't know, which is the second level down, liquidity problems. So there were some problems with liquidity being available, but there weren't too many problems with liquidity. So that sort of, the economic, the financial side of things was facing some pressures, but not too many pressures. And then the capital side of things, Canadian companies still felt confident in investing their money into these growth creating opportunities for the long term. So there weren't that many capital problems going on in the economy. And those were the reasons why we saw that V-shaped curve, a sharp decline, but a full recovery back to the pre-crisis growth projections. So that is one lesson that we learned on how to manage and what kind of problems can have long-term impact on the growth of the economy. Now, when we go and look at the United States, what problems were they facing? Their liquidity problem was more pronounced. They faced a more extreme problem with liquidity. There wasn't enough money flowing around in the system, in the economy, for them to, for us in the US to be able to break through and plan for that long-term growth. They also have faced severe, not as much, but pretty good, pretty deep capital problems. Companies didn't feel confident about investing in more projects, in more capital producing and growing projects within the United States. And we saw a lot of companies actually taking their work offshore even during that time. So companies weren't feeling confident. Now, because the capital problem wasn't so pronounced, while liquidity was pretty serious, a serious problem, we did see that the economy fell pretty strongly during the crisis, uh, stayed there for a little bit, climbed back up, but wasn't able to get back to the pre-crisis levels. So while the economy kept growing at a pretty strong rate, it never went back to where the predictions were from before the crisis. So then we saw what happened in Greece. In Greece, unfortunately, they had a lot of financial problems, not just with liquidity, but also with capital. Their financial systems, their central banks, the companies in the country, everyone faced a huge amount of liquidity and capital problems. People just had lost the confidence in the government to be able to come back out of this in any good way. So the bonds, the Greek bonds suffered quite a bit, and we if you think back, you look at back, you'll see a lot of those headlines coming from the news. And that is why in the longer term, after that deep decline, they did manage to get back up because of some measures that the government took and their central banks took, but it could never help the economy get back to the same growth path. And then the growth in the economy just kept falling. They've now looking like there might be some steady rate of growth. But again, with this crisis, although we haven't heard so much in Greece, but with this crisis, we don't know what's going to happen next for Greece. So these were the lessons that we learned. Now, how does that apply to what we're seeing today? What we're seeing today is, not just the problems in the financial system, but real economy is frozen. Now, you might ask, what is the real economy? It's people like you and me. It is all, restaurants and bars and nail salons and malls and retail shops and all these different players that come into play, that come into play in our daily lives, are basically frozen because of social distancing. Everyone's staying home, businesses are closed, there are, people are working from home, so they're not traveling. Because of social distancing, all vacation plans have gone out the window. Schools are closed, they're doing distance learning, and that's really impacted the real economy and frozen the real economy. So, we've heard of instances like, if you're a business, you're not getting any revenues, so you can't pay rent, you can't pay your employees, you can't pay the utilities, and there's no liquidity. I don't have cash to pay anyone. So there's the liquidity problem. And then if with all this going on, businesses also face capital problems. Do they feel confident in investing their money into creating more growth opportunities? They don't feel confident right now, at least. The real economy is frozen. People are out of work. There's severe cash flows that they're facing right now. And then, in terms of capital, people may have to actually borrow money to stay afloat, to meet their expenses that they really need to meet. And even companies are having to borrow money to meet their expenses. So this will really impact the investments and ultimate growth of the economy. So there's not just financial issues, but there's also the freeze on the economy that's going on. And that's a big difference between this crisis and the previous crisis, is that the economy is doing just fine before all this hit. And now, because everything is so frozen, people are not able to move out of their homes. There is an almost artificial freeze that's going on. So the key question is, if you move to the next slide, Paul, the key question is, what can we be doing now so that we're able to, with, to actually go through this difficult period and to not get that type of shock as we'd seen earlier. So effective policy responses, Federal Reserve, the government, Federal Reserve coming into this decrease their rate of interest to 0%. What that did is allowed banks and even the US government to lend money at really low interest rates. And this so that businesses are not disabled by having to pay those high interest loans. So far, the Federal Reserve has intervened with their initiatives, and then the CARES Act from the government. They are pumping money in to small businesses. They're sending money to individuals in the form of extra unemployment checks. They're sending those $1,200 checks to people. So we are looking at, it could be both a V-shaped and possibly even a U-shaped economy growth turn, recession right now. So the big question, Paul, if you want to go to the next slide, the big question that we're asking is how much longer is this freeze on the real economy going to be? How much longer do we have to stay in? What are the impact? What is the research showing about the virus, the disease that it creates? Are people recovering? What is that trend that we should be expecting in the next few weeks? And maybe it's not going to be universal. Maybe parts of the country are able to go back to work and are able to get out of their homes sooner than other parts of the country. And I don't think there's going to be a good answer, a perfect answer to this issue. Whatever they do, I'm afraid there will be some mistakes made, unfortunately. And what are investors to do through all this? Paul, if what are we supposed to do as investors, as just regular folk trying to get through?
Sure, Avni. Thanks for setting up some of these. I'll be honest, scary scenarios, and then now I'm supposed to tell everyone, well, this is exactly what you're supposed to do, and you'll be hunky dory. But giving me the easy ones. Now, and something that we did talk offline, Avni, was that it could be, as you mentioned, some industries come back faster than others. So it might not be that you can envision the whole economy moving in a V or a U shape or whatever other shape you want to come up with. It could be that it's a mix of the two. So bumpy road ahead, I would say, is the best prediction that we can make without, of course, ever having a crystal ball to rely on. Having said all of this, even with 2008 being the worst economic period since the Great Depression, time and time again, we have seen the capital markets come back, in particular the equity markets, stock markets, particularly here in the US. So it's not a matter of if, but when. And you don't want to be caught on the sidelines when that inevitable rebound does happen. So what this is a graph of is the MSCI World Index. So what it does is it tracks the world stock market. So think of just essentially the largest public companies in the world having some share in them and their growth over the last 50 years. So this is from 1970 to 2019, where there were a lot of ups and downs, bumps in the road. There was an Arab oil embargo in the 70s that led to oil prices quadrupling and inflation was a huge issue then. Massive drop in the stock market in 1987. There were wars that went on. There was September 11th, of course. And then here we can see 2008 and 2009, the credit crisis that led to the so-called Great Recession. And if you stayed invested from 1970 to 2019, $1 would have grown almost to $70. If this chart continues through the first 3 months of the year, I would imagine it would land somewhere around here, somewhere in the mid to low 60s. And so that's to say that investing is never easy. We're hearing the words unprecedented. That's for sure. All of these events that have happened before were unprecedented. They were unique. Eventually, the economy recovered, and as so did the stock market, because that's, as investors, what really affects us if we are invested in the stock market is we want to reap the rewards that we've seen over time do happen. And if we look even further out, and this is only focused on the S&P 500, so this is domestically the largest 500 public companies in the US, you can see in the green, these are the periods of so-called bull markets, where the growth in the S&P 500 has been greater than 10% over periods of time. And just visually, you can see that these bull markets, these great times to be an investor, particularly in US stocks, outnumbers the bear markets, which is the ugly cousin of the bull, is the bear market. And that's where we can see here the Great Depression was, of course, a terrible time to be an investor. And then there are little periods where the economy goes through some sort of contraction, whether it's officially a recession or not. We can see that there are some short-term losses. I do want to emphasize that it does end up being relatively short-term, though, of course, in the moment, as an investor, day by day, whether the market goes up or down is essentially like a coin flip. The market has been up somewhere between 53 and 55% of the time on a daily basis. So it's like a coin flip in that term. But the longer you stay invested, the greater the odds are in your favor that you actually will see growth on your investments. And that is evident. I'll get back to this slide. But that's evident here in this chart, where on any daily basis, you can see 53% of the time, the market is up. Over 3-month periods, market is up 70% of the times. We just went through a 3-month period where it was that other 31%, where it was indeed down. 75% of the time over any, if you just pick a point in time and you look over the last 12 months, 75% of the time you would have actually seen your money grow for you if you were invested in US stocks. And it's 100% of the time if you choose any point in time, including today, including the more recent market low that we saw at the end of March. If you look past 20 years, you would have made money by being invested in the S&P 500. So what that's telling us is, what these numbers are essentially telling us, is that the market is constantly testing us because of times like now, 2008, even there was a period at the end of 2018 where it seemed like a recession may have been on the horizon that didn't end up panning out. For investors who stayed disciplined, who had an investment plan that didn't involve being entirely invested in the S&P 500, but rather having some stocks here in the US, some stocks abroad, bonds, of course, depending on your situation, as long as you stuck to that plan, if it still made sense for you, that you were ultimately rewarded. And we will see that happen this time around again. So as we right here, making sure you're diversified globally, because as Avni was pointing out, in '08, Canada happened to have actually a better recovery than here in the US. So it would have paid off to be invested not just in the US. So that's where we see diversification really come into play during these more testing and difficult times, when there are more difficult economic environments to be an investor in. And here is another graph that just illustrates how important it is to stay invested and to be a disciplined investor, where if you had $1,000 invested in US stocks 50 years ago, and you stayed invested for the entire time through the ups and downs, that $1,000 would have grown many, many times over to $121,000. That's through March 2020. If you miss just the best day in the S&P 500, the difference, you would have lost about $13,000. Okay, not so bad. But if you miss just the best 5 days, your growth is almost half of what it could have been. If you miss the best 15 days, it's a fraction. Miss the best 25 days, it's an even smaller fraction. So it's an unfortunate caveat, so to speak, or unfortunate just kind of maxim of being an investor, is that you do get punished if you take your money out of the market and assuming that it's still appropriate for you to be an investor. If you do that, you will miss out on growth in the long term. And it's a lot easier said than done. You know, it's investments 101 is to buy low, sell high. However, as humans, our emotions almost run counter to that. When the stock market is doing well, prices are high, we're at this elation point here, and that's where we might get a little greedy, and that's where we see a lot of investors start to pile in their money, is when they see markets continuing to do really well. They've got this fear of missing out, and so that's when they're buying in is at a relative high point. Then there's some sort of downturn that leads to stock market prices dropping, and then there's the fear point, and that's the low point in prices. That's when logically you would want to buy in. It's like having a flash discount sale at your favorite store. That's when you would want to be a buyer, but that's the time when many investors actually they've had enough and they want to cut their losses and run. And so we did see that happen in 2008. What was promising to see is that the data, at least in last month when all of this news was coming out and stock markets were in a bit of a free fall, is that most individual investors actually were staying invested. So let's see if that's if this turbulence continues, if that's going to stay the same. But at least this time around, it seems like more investors, especially individual investors, are staying in, which is something that we did not see in 2008. And inevitably it will come back, and those disciplined investors will be rewarded.
That's right. And all this, the talk about how to manage emotions through the market, but even otherwise, as we're facing social distancing, we emphasize a lot, and we highly recommend doing self-care, keeping yourself active, keeping yourself, emotionally and mentally charged, and emotionally and mentally actually calm, not charged, but doing something actively to be able to take control of that aspect of this crisis. So we're inviting clients, friends, loved ones to virtual workouts, and these are coming up. We do them every Thursday evening at 5:30 p.m. So the couple that are coming up on April 16th, our very own Deborah Donenfeld, who is a certified yoga teacher, will be doing a yoga class. And then on April 23rd, we have Dr. Laura Miranda, who will do a more strengthening and toning workout class. Please join us. There's a link for the Zoom session. We can send it out as well. Both these sessions are open to people with all levels of fitness. So they will show modifications if you're not doing the highly rigorous exercises, and they will take, it's a very easy process. I've been attending these and they've been great. One way that I feel helps me manage my stress. You'll also see we've installed this pull-up bar in our home, which is helping with, just keep up our strength. I am not able to do any pull-ups just yet, but I'm working on it. So we encourage you to take care of yourself physically, emotionally. Reach out to your family, your loved ones, people you haven't talked to in a while, and just say hello. And make those, keep those connections going. I'm also keeping an eye on the chat. So if anyone has any questions, any comments that they'd like to make, please feel free to add them to the chat box, and we'd love to take them up. I know we've taken up a lot of time this morning as well. So in case nothing comes up for you right now, feel free to send us, those questions and thoughts. We'd love to hear from you. I think, Paul, we should put, stop this webinar now so that let people get back to their day. Do you have any final thoughts?
No. I guess just feel free to reach out to us if you do have any questions or concerns or just want to chat. So we'll be here.
Sounds great. Thank you, everyone, and have a wonderful week. Take care.
Bye.